Well, good morning, everyone. So happy that you are able to join us this morning. Uh, I was a bit overwhelmed when I saw the number of registrants today. These are obviously hot topics, and I appreciate you giving me the opportunity to review the current data and addressing the media's talking points that everyone is concerned about. Little housekeeping item, please note your questions. There will be ample opportunity in the latter part of the presentation to answer them. Several of you have submitted questions in advance, and I'll be addressing those as we begin the question portion of the presentation, or they'll be covered during the presentation. For almost 2 years, Americans longed for the many pre-pandemic lifestyle norms: time with the family, time with friends, travel, freedom, and of course, spending money. That's what Americans do best. This has resulted in supply chain shortages, inflationary pricing, and market volatility. So, what does this mean to your financial plan? Well, that's what we're going to talk about. So, we're going to take a look at inflation, volatility, and since we originally announced this presentation, I'm going to talk about the R word, recession. So, without further ado, let's roll. Well, what about inflation? Well, in my world, inflation is the nastiest of taxes. It erodes the purchasing power of those who can least adjust for it. Think about it. If you're a family on SNAP or other extreme fixed income, and the largest percentage of your budget goes to food, energy to get to and from work, and housing, you've been slammed in 2022. If you're not feeding a family, not commuting to work, not buying a new home, or not having a rent increase, you're not getting the brunt of this inflationary period and inflationary changes. But I don't know too many Americans who don't do some of those things, so that's important. So let's look at the defense. What can we do? I always look at Wall Street versus Main Street versus Pennsylvania Avenue. Wall Street, of course, large corporations generally find it easier to pass on inflation-driven price increases to the consumer. Recently, there's been some press about the battles between food companies, the grocery stores, and some of the providers, and the fact that the grocery stores are beginning to push back and ask the food producers to explain why they're having to increase their prices dramatically. But of course, where consumer spending goes, corporate earnings will follow. And this presentation is about financial plans and investing. So we'll look at the corporate earnings side of this, and the social aspect we'll work on our own. Main Street. Small business meets the consumer face to face, and it becomes more difficult to pass on the price increases. So generally, small business is slower to pass on those increases than, of course, the somewhat blind or invisible corporation passing on the costs. I mean, it's hard to argue with Exxon or Chevron when you pull up to the pump to fill up. I filled up yesterday and I hit a new high. About 3 weeks ago, I filled up at 101. And yesterday, I filled up and I hit 103. So I guess my next milestone in a couple of weeks will be 105. Just amazes me. Pennsylvania Avenue, how do they look at the inflation? Well, as we all know, everything that happens on Pennsylvania Avenue is politics driven. There's one game plan, and that's to win in November. So whatever it takes to have the appearance, have the talking points, have the, oh, I hate to say this, have the lip service regarding inflation, that's the name of the game to get to November in the midterm elections. Remember, we're in an election year. I came across this the other day and I couldn't help but bring it up. I don't know how many people on this presentation are young enough, see how I said that nicely, young enough to remember the WIN buttons. I do. WIN stood for Whip Inflation Now. This was back in 1974, and it was an attempt to spur a grassroots movement to combat inflation in the U.S. This came from then U.S. President Gerald Ford. The campaign was later described as one of the biggest government public relations blunders ever. I guess this ranks right up there in the corporate world with New Coke back in the 80s. People who supported the mandatory and voluntary measures were encouraged to wear their WIN buttons, perhaps in hope of invoking a peacetime with the kind of solidarity and voluntarism, pardon me on that word, symbolized by the V campaign during World War II. I think what really happened with this is it gave business an opportunity to not do pay raises that were anticipated to keep up with inflation. And when you couple this with just coming out of the oil embargo, this was a very turbulent time in the US economy. But it's different this time. Inflation investing defense. Okay, what are the inflation and favorable assets? The first one, of course, is equities, especially dividend paying equities. Next is precious metals. Proceed with caution. Kathy always reminds me that precious metals are a great investment, especially if they come from a nice jewelry store. Real estate. Real estate generally keeps pace with inflation. So, again, small businesses are able to pass on price increases, and they're able to continue to grow and grow in value in an inflationary time. What are some inflation unfavorable assets? Well, obviously cash. If you've got money sitting in the piggy bank, the sock bank, or the bank of the mattress, keep in mind, while you still have those dollars, you just don't have the purchasing power you had because of inflation. We look is 8+% at this point. So theoretically, the piggy bank lost you 8% last year. And of course, fixed income investments like treasuries, CDs, and I'm going to talk more about real return on those inflation assets later in the presentation. Of course, we've just gone through a correction in the market, and I've had the question of, was the market due for a correction? The answer is absolutely. Corrections are the normal course of the market's existence. We've had them as far back as you can chart them. It's just a part of the process. The market takes a break, takes a breather. So when we look at corrections, a correction by definition is a 10% or more, but less than 20% decline in the market from its high. So when you look at the chart and you see the blue shades represent corrections. Then we have the red shades or pinkish shades, and those are, of all things, bear markets. So we all kind of remember this nice big one back down here in 2008, 2009. Ugly bear market, 517 days we got to endure that. And then you have to think about it. We actually had a 32-day bear market a little over 2 years ago. Of course, we know that was all caused by the pandemic and the uncertainty, and you can see the immediate drop. So these are real. They are just the normal course of our activity, but we have to look at the long-term trend line of looking at the S&P 500 as a reflection of the market. So let's look back at the driving force of fueling this growth in 2020 and 2021. The government was stimulating the economy. Let me put it this way. What happens when you give a child candy? Most of the people on this call are parents or they've had children, grandchildren. And if you give a child candy, they get stimulated. And that's awesome because they have fun, they're playing. But what happens a little later? They crash, and it isn't pretty. But they recover. And this is much like what's happened to the economy. We've been giving away money, or I should say, not we. The government has been giving away money, printing money, stimulating the economy, and now that stimulation has stopped, and it's time for the recovery. And that's what we're seeing in the economy right now. Couple that with inflation, especially in the energy cost, things get cheaper, of course, when there are no buyers. Keep in mind, we didn't have buyers for gas at the gas pump back during the pandemic because the cars are sitting in the garage. So rising interest rates are, of course, a factor. And oh yeah, a superpower invading another country. Wow, things are volatile. And all those things are leading to the market correction, market adjustments, and tipping that bear market that we almost got about 10 days ago, I think was when the S&P intraday trading got below the 20% mark, but closed above just barely. So planning for a lifetime income in an inflationary environment. You know, I meet with clients all the time and talk about the retirement issues, whether it's a planning issue or whether it's a living issue. And the key thing we run into are generally two questions. Will my income outlive me? Or will I outlive my income? The whole point of retirement income planning is trying to make sure our income outlives us. A personal item. Years ago, I met with my mother to review her financial plan. After going through the calculations, I told her that at her current spending rate of earnings and spending, or current rate of spending and earning, she would run out of money at about age 114. She told me that when she reached 114, she would come looking for me. I told her she better look to her grandchildren. Keep in mind when she would be 114, I would be in my 80s. Well, she only made it to 96, so we never got to find out exactly how that would work out. But it's a case of taking a look at your own plan, taking a look at your own spending, and saying, okay, how long can I hang around this world? Those are important things in looking at retirement planning. So the essential retirement answer is for it to outlive us, our income must grow at least at the rate cost of living grows. Now, we've heard the 8% inflation rates, and that's a very broad measure of the economy. The reality is, for some of us, we've seen the brunt of that inflation. For some of us, we haven't seen. It depends, again, on where we're spending or where we intend to spend our money. The challenge is to create an income stream that is dynamic. It has to rise through time to offset inflation. So obviously, the piggy bank and the bank of the mattress won't work. The critical issue turns out to be not so much the level of your income, but its trajectory. Let's take a look at fixed income, and we realize immediately that fixed income is not the answer. On fixed income, of course, the income stays fixed. Wow, what a thought process with just the pure the definition. But the cost of living, as we know, continues to increase. So even if your fixed income is above your income needs in year one, your costs immediately start catching up. So when and where do those lines cross and that become the issue? The issue is that if they cross, you start running out of money because you're dipping into principal to make up the cash shortfall. And that's a downward spiral. We know the math. By the way, if you start into a retirement and a fixed income that's half again of the income you needed day one, at 3% inflation, you cross the line and start dipping into principal in year 14. Again, at 3% inflation, something to think about. So even if you aren't preparing for a 3-decade retirement, it's preparing for you. Keep in mind, it's interesting. I've had meetings with clients who were retiring and they're in their mid 60s. And one of the things I always ask is, tell me about your genetics. Tell me about your family. When did your parents pass away? And sometimes I'll get the response, I didn't know they did. We find out that mom and dad are in their mid to late 90s. And so just from a DNA perspective, we have to assume that that 65-year-old has another 30 years to live. That's 3 decades. So right now, the joint life expectancy, put that out of insurance and put it in English, that's the point when the second person of a couple passes. If we look at a non-smoking couple retiring at age 62, well, that's the exact joint life expectancy aged 92, so 30 years. So because you've had better educations, better healthcare, better jobs, more income, don't count on being average. I know the people on this presentation this morning, and believe me, you're not average. You're awesome. Looking at that, where historically do we find that kind of rising income? Well, it's owning companies, not lending to them. So here's the point. Fixed income securities, by definition, don't produce a rising income. Mainstream equities, and I'm going to use the example of the S&P 500, historically do most notably in the form of cash dividends. That's the machine. That's the taxi drop, that cash flow coming out regularly. So to summarize that, rising income and sharply rising income at that has the most reliable way of being produced through the ownership of successful companies. So you have to ask yourself, how has the market kept up with spending? So let's look. Dividends since 1960. Now, talk about dividends for a minute. Since 1960, the consumer price index has multiplied 9 times. The cash dividends of the S&P 500 have multiplied 30 times. Okay, so we can do easy math. It's not even close. If the cash dividends are up 30 and it only went up 9 on the cost of living, your standard of living was able to be increased over that period. A little side note, by the way, since 1960, the S&P 500 value is up 70 times. So that's the key for you. Rising equity values over a long period of time have given you more room to make withdrawals for those things other than just the regular living expenses you might like. And it's built wealth that's been able to be left to subsequent generations. So that's how it's been built. But let's look at achieving financial independence overall. The 6 things that lead to it and creating financial independence, starting at the top: asset allocation and location. What are you doing with your assets? How are you diversifying those? In other words, a mix of stocks, bonds, real estate, maybe a small business. All those things add to the allocating the use of your assets and keeping that balanced and shifting it, because each of those items does better at different times over your lifetime. Working on market returns. You generally have a minimal amount of impact on the marketing returns other than looking for the solid companies and having the asset allocation. Taxes and Social Security. Well, as we've heard all along, death and taxes, including the Social Security tax, they're real. And so being tax efficient is the way you can control it. Longevity, being in the market for a long time, as well as keeping yourself around for a long time. A couple of things that are very important for you. Employment and earnings, putting that money away into the 401k and the retirement plans, and of course, spending versus savings. You know, it's interesting. As I pass through the grocery store checkout line, there are all the tabloids that are up there, or all the different magazines. And it seems like every one of them, as you've just gone through buying groceries, has the latest fad diet on the cover. Last time I checked, the key to dieting was to burn more calories than you take in. It's a pretty simple mathematical formula. Well, the key to financial independence regarding saving and spending is to bring in more money and save it than you spend it. So it's easy math, but hey, it obviously isn't easy to do. And that's the key. Taking it requires discipline. So focus on the things you can control and have a plan to diversify and protect yourself on the things that you can't. All right, we got a period of high inflation. So what does the normal family do? Simple stuff. Number one, review the household budget. You know, have you got those TV subscriptions, things, the various channels and streaming services that you haven't looked at for 3 or 4 months? Might be time to give them the boot and look through at the places where money just seems to come out. Are you really receiving the benefit of it? Is the family emergency fund funded? Well, what's the emergency fund? Well, we look at about 6 months of your family's living expense in cash, just in case there's the emergency. We watched this and it got battle tested a little over 2 years ago when we hit the pandemic. Wow, this was a new place. We hadn't been through one of these before. People suddenly found themselves unemployed. The stimulus program isn't in place yet. Wow, do we have that emergency fund? Maximize the retirement plan at work and maximize the retirement plan if you're managing it on your own. Pay off debt. Keep in mind, what you're earning right now in the market is probably a whole lot less than anything you're paying if it's debt. Now, if you're one of the folks who was very fortunate in the last couple of years and you've got one of those 2.5%, 2.75% mortgages, don't pay it off early. That's almost free money after taxes and inflation. So it's a great thing to have. Delay major purchases. I mean, let's face it, if you've looked at appliances and cars right now, the companies are very proud of their product. Why? Simple. Economics 101, supply and demand. There's high demand and low supply. So the end result is they're pricey. In addition, you've got delivery time frames on them. So if you don't have to do a major purchase, sit back, wait. It'll improve. So enough about inflation. What about volatility? Well, we always hear it's different this time. The reality is yes and no. The greater the uncertainty, the more fearful the media reports, the greater the volatility. Simple social mathematics. It can be a rough ride. It has been a rough ride. This hadn't been a fun 5 months at all. Keep in mind, historically, the best days in the market generally recur within 2 weeks after the worst days in the market. You know, as we've seen, many of you have attended our quarterly economic updates, and you know there's always a reason not to buy stocks. But keep in mind, for every seller, there's a buyer. So somebody thinks it's a good deal at that price, whatever that price happens to be. Let's go back to that previous slide that we had on market fluctuations. Keep in mind that when you look at this and you look at the V's, I'm just going to call them the V's, and we got a couple of W's in here, but let's focus on the V's. You notice how the downward action is almost equally offset by an upward reaction, how those V's almost look totally symmetrical, how the W's look symmetrical. And so historically, what we see when there's a market fluctuation is that downward trend is replaced by an equal but opposite upward trend. And that's been the history of the market as far as you go back. So while we hate volatility, we hate the wild, crazy market fluctuations, it's just the normal course of things. So don't lose sleep over it. That's the key. Is the market due for a recession? I wasn't going to cover this beforehand, but obviously the thought processes in the media, this has just come up more and more. So is the market due for a recession? The answer is absolutely. Recessions are the normal course of the market's existence. The next recession will be the most anticipated I can recall. I, as you might imagine, subscribe to or receive a lot of financial information. And pundit after pundit is sitting there going, oh, there's a recession coming. There's a recession coming. Well, it's a little like saying, is the moon going to rise? The answer is yes. Now, I don't know what time. I don't know what moon we're going to have today, but I know somewhere in the future there is a recession out there. And so if you go on the market, like I just did, and said the market is going to have a recession, that way when it happens, you can go, see, I told you so. Well, it's kind of hard to be wrong because it's there. Now, exactly when the next recession is going to take place, well, that's where you got to be the genie or genius to pull that out. So first off, let's make sure we understand what is a recession. A recession is when you have 2 or more consecutive quarters of negative GDP, gross domestic product, negative growth. That means you're not growing. Okay. So we're already halfway there technically, because last quarter was a negative 1.4%. So am I predicting a recession effective June of 22? Absolutely not. Right now, we're 2/3 of the way through the quarter. And unless the American consumer recesses themselves into recession, let me repeat that, recesses themselves into a recession, the fundamentals are strong enough to delay it. But a recession is inevitable. And I don't think anybody can tell you, yep, it's going to be the second quarter of 2022. We hear, nope, it's going to be in 2023. I mean, in all honesty, if I went through a couple of financial publications just sitting out there today, I've got one that'll tell you there's a recession coming every quarter going forward for the next year and a half. But they're paid to write. So my key is, and hopefully your takeaway, that this, to the average investor, this really means that the recession doesn't necessarily mean 2008. Keep in mind, 2008 was called the Great Recession. But having a short-term recession or 2 quarters of negative GDP, this is the normal course of things. It's kind of, I'm going to go back, it's my sugar high child catching its breath. That's the key that you look at in approaching a recession. 2 quarters, negative growth. There's plenty of reason to be optimistic. I'm going to share a small but hidden gem. As I said, I read a ton of investment publications and I get a ton of useless but valid information. There's a small but generally hidden one, and that's and this has been sudden, kind of a sudden significant upsurge in insider buying. Now, this isn't the illegal insider trading. This is insiders who are buying. There's been approximately 1,100 corporate insiders. These are corporate officers, board members, who have been buying shares in their company just in the month of May. The number of buyers for the first time since March of 2020, the buyers exceeded the sellers. Now, why is that? These are the people who know what's really going on in the company. They have firsthand knowledge. They have to disclose that they're buying or they're selling because they're insiders. But they're personally making financial decisions that say, I like this company at this price. And actually, there's some other reasons. Valuations have dropped. The market's on sale almost 20%. Consensus earnings against all apparent reason and logic continue to rise, and pricing in the market has cratered. So with the S&P around 4,000, I'll use that as a ballpark benchmark for the presentation today. The 12-month forward PE is down to close of 1/3 from the peak. It's to about the 10-year average. It's about the true value of the company, not the next tick in the stock market. Look for the underlying earnings. Look for the dividend yield. Those are the things that you need to be paying attention to, not some pundit who's predicting, oh, XYZ is washed up. You know, this company's, forget them. Usually that's a good time to be buying when the market's thinking about that. Last week, the Fed minutes and that subsequent rally created, it's starting to look like the markets may have turned the corner. We're hopeful. With the market grossly oversold and valuations at more than 2-year lows, there's some more days and weeks ahead that hopefully are positive and long overdue. Another interesting item, consumer confidence beat expectations when it was just released. It came out at 106.4 versus the consensus of 104. So while the media again is telling us the consumers just, scared and running, no, they're not when you actually ask them and look for what they're doing. Think about it. Those seeking jobs have a lot of choices. Those with jobs are leaving for higher wages and other choices, and unemployment remains extremely low. Several of the publications that I read anticipate that tomorrow's labor report that will come out will reflect a potentially drop in another 1/10 of a point of the unemployment rate. Other good news in the housing world, lumber prices are back to pre-COVID levels. I remember going in Home Depot and just seeing the changes in lumber prices during the last couple of years. It's just been crazy. The bad news is your burger or steak is going to get pricier because of some of the beef situation that we have. So there's always good news and bad news. It's not always lollipops and unicorns. So investing in certain times, I always ask the question, when was the last time times were certain? I can't seem to recall, but hopefully we'll come across that. So where should I invest now? This is obviously an important question. It came from 2 of our attendees today. And so here's what we know. The Federal Reserve is scheduled to meet in about 2 weeks' time. It's a little under that right now. They're expected to raise interest rates by 50 basis points. For those of you who don't deal in basis points, that's 1/2 of 1%. They're expected to do the same thing in July. Keep in mind, as we go through the next few slides, we sincerely believe that this is coming down the pipe. They publicly said that this is what they're anticipating, and so we don't see any reason for them to go otherwise. In where to put your money now, my first question is always, what's your objective? Is your objective liquidity? In other words, are these funds that you're going to need in the next 90 to 160 days? Is your objective safety? You really like to have something that's FDIC insured, or like a US Treasury, for example, guaranteed by the credit and faith of the US government. Are you looking for income? So you want the highest dividend or highest interest rate you can get your hands on. Are you looking for growth? Maybe it's a company that doesn't even pay a dividend, but the popularity of its product or service is such that it is growing faster than the general economy. And of course, what's your time frame? In other words, if this is money that, yes, you need in the short or intermediate term, that gives you different investment options than if your time frame is, this is really for the next generation. So it may be 20, 30 years before this needs to be cashed in. All those are the objectives that come into, okay, where's the proper place to have your money now? Which begs the next question. What's your real return? And it's interesting because when I taught back at JU, when I taught investing, corporate finance, getting this through to people or students was very interesting. And it was a period of high inflation. This was back in the early 80s when I was young and taught college as well as being a CPA. So what's your real return? Very simply, it's the yield, and that could be interest yield or dividend yield, less the taxes that you have to pay on it. Remember, death and taxes guaranteed, less inflation gives you that real cash return. That's the money in your pocket. And then, of course, it may be an investment that grows in value. So where do you put your money? Let's look at a couple of options. First one, CDs. I went out this morning to a service called bankrate.com. I don't know if any of you have ever looked at Bankrate. Bankrate is a wonderful source for looking at what are market averages. And you can look at averages for CDs. You can look at averages for mortgages, a variety of different things out there. So I just did a 1-year yield CD. If you look at that right now, there were several out there in the range of about 1.5%. Keep in mind, the feds are getting ready to raise interest rates 0.5% in the next couple of weeks, maybe even another half within the next 6 weeks. And so as a result, that 1.5% CD today might be 2.5% in 6 weeks. So you got to think, do I want to lock my money up for a year? I don't know. Maybe I got to think about that. I'll keep it over here in my money market or the bank of the mattress for another few days. It's your decisions. On that 1.5%, and I used a 25% tax bracket. I realize some of you are in 35 or you live in states outside of Florida, which you shouldn't do, and you're paying 40 or more percent in income taxes, but I used 25 just for the calculation. So less taxes, and I used 2% inflation. Keep in mind, that was the long-term Fed target. I didn't want to put 8 3/4 in here and just blow this money out, blow the equation out. You wouldn't pay any attention to it. But that gives you a negative real cash return. That some people call negative a loss of about 7/8 or 8.75% that you, or 0.875% that you've lost just in the purchasing power of that money. And of course, a CD offers no growth. All right, let's get aggressive. Let's go to a bond fund. And I looked at a bond fund that it's got maturities of about a year, so it's fairly short term. You can find those paying about 3%. You subtract the taxes, again, 25% tax rate, because these are taxed at ordinary rates, and inflation. So your real return is about 1/4%. Not great, but you're not losing money at 2%. And I'll let you decide what you think the inflation rate is going to be the next year, but I'm just going to go on the hook and say it's not 2%. Of course, with a bond fund, no growth. So we're 0 for 2 on growth. So let's look at a dividend paying stock. And I just picked 3%. There's tons of companies that pay 3% or better right now. Then they pay that, of course, per year. So 3% per year, less taxes. Well, keep in mind, the dividend tax rate is only 15% versus my average tax rate I used of 25%. So that's 0.45%. The inflation again, and at least you have a positive return. Now, I didn't put anything for growth because there's a possibility, one, it may decline in value. Two, it may not change in value. Or three, it may go up in value. You have to look at the quality of the companies that you're selecting. But at least you got a chance of winning. On the other two, we know you had a chance of probably not winning in this economy. So what do you need to do? Buy companies, not headlines. Look for the companies that are taking the time to pass on their increasing cost. They're able to raise their prices, and their demand is equaling or outweighing the supply they're able to bring. We've seen a number of companies that have said, hey, things aren't going to be great this quarter because our supply chain is clogged. But when we look at next quarter and so on, we're expecting tremendously good things. Be an investor, not a trader. Okay. Always like to define that. An investor is investing for the longer term. A trader is looking to play on the headlines. I know many people on this call side accounts that are your trading accounts because our methodology isn't to be a trader. Our methodology is to be an investor. And so it's important that you, if you want to be a trader and get in and out of the market quickly, have your own thing, have at it. Sometimes you get home runs, sometimes you don't. Know what you own and why do you own it? What does this company do? There's a product called Value Line, which is we use to research companies. Really great in telling you what this company actually does. And that's always interesting to know. And of course, the odds are good. You're spending money on companies that are in your portfolio. Stick to your plan. Stay in that long-term lane. Don't get into panic mode and drop to the sideline. Avoid emotional decisions. It's always interesting. Occasionally, every couple of years, we get to go to Boston, Volatility headquarters, and one of the things they have in Boston is a chart room. And in the chart room, one of their charts shows when a company gets press on a multiple of magazine colors, usually within 6 months, their stock has fallen like a rock. It's almost like a Sports Illustrated curse. It's really interesting to look at that. So when a company's being beaten up in the press, take a good hard look at it before you go, oh my gosh, I read an article and it said, oh, they're about to die. I've read that on companies that literally have billions of dollars in cash. Last time I checked, companies with great earnings and billions of dollars in cash generally don't go out of business in the short term. Diversify, diversify, diversify. I spoke earlier about stocks, bonds, real estate, small business. Keep your portfolio diversified because those assets tend to shift in different directions. And use walking around sense. Again, where do you spend your money? Where do you see people spending their money? All of those are keys to just walking around and seeing what's going on. You've heard it before from me. One of my economic indicators is simply riding through the town center here in Jacksonville. I learned back during the pandemic, of course, you don't look at people walking. A lot of people walk the town center just for exercise, just for fresh air. How many people are carrying bags? How big are the bags? How many people are carrying multiple bags? What are the stores of the bags they're carrying? That tells me how people are spending money. Again, it's the American consumer who drives the marketplace. So, time to ask some questions. I've been hitting it. The chat box is open. Please feel free to type in your questions. We've had a couple mentioned presented earlier about where to put your money now. We had the question about changing to talk about the recession. So does anyone want to throw something in there? Gee, I know I didn't do that great a job. See what we've got. Well, gosh, no questions. I'll give this another second just to see. Again, I'll always appreciate it when you type your questions in early because it gives me a chance to make sure I get them into the presentation. Let's see. Here we go. With all the uncertainty and volatility in the markets, how big should your emergency fund be? Wow, that's always a good question. To me, it's a range depending on how confident you are about your upcoming income. For example, you're a retiree and your income consists of a pension from a government entity or a company, and you know the pension is funded. Social Security, you know that's coming. And if you can live off of those two things, you're not dipping into the investments, you keep the emergency fund period a little shorter. If, however, your emergency fund depends on your income or your investments, I encourage a minimum of 6, preferably 9 months in that emergency fund so that you're able to weather the storms. Again, this was battle tested back in 2020. So those would be some of my favorites. Let's see, discuss investing in precious metals. I mentioned Kathy has a great methodology on that, but traditionally when you look at precious metals such as gold, silver, the fluctuations on those and the cost of having those custodied, just really, those things outweigh what the return has historically been. Now, granted, if you wake up somewhere between 1 o'clock and 6 o'clock in the morning, I guarantee you there's an infomercial from somebody telling you you need to buy gold. The reality is not only do you need to buy gold, but you need to custody your gold with them. You get the picture? Always be careful when you're getting those infomercial presentations that tell you, hey, this is where you should send your money, because the odds are good they're making money or they wouldn't be doing the infomercial. So those have never been hot to go for us. So not there. What do I do with my cash? You said to not pay off the mortgage at 2.875. What else? Well, on the cash side, of course, if you still want to keep it liquid, you still have a time frame, you're really limited to those CDs. If, however, that cash you look at and you go, hey, I can just stick it out there, then that's where you move up the investing spectrum. If it's just purely cash that you want to make sure you have in the next 6 months, if you're going to need it, unfortunately, you're stuck with the money markets and the CD, or possibly an ultra short-term bond fund, something that matures very quickly. Little more aggressive than a money market fund, but still nothing that goes out a long, long term. I mean, if you're feeling uncertain about the next 6 months, imagine feeling uncertain about the next 2 to 3 years. Let me see if I can move the chat box over here. We're going to sell our house when we move and plan on renting for a year. How should we invest our proceeds for the sale? 1 year term frame, you got to be careful, or 1 year time frame rather. So I would limit that to only things that are available to you that you have that guarantee, because again, you know you're going to need the cash. You're probably looking at CDs and federally insured CDs at your best options. Again, when you know you got to have the cash within a year. I have many times that people will talk about, I'm going to take the cash, I'm going to go into the market, and The challenge with going into the market, of course, is maybe you get to month 11 and suddenly there's another pandemic. And boom, you've just lost 20, 25, 30% of the value of that portfolio, but now you got to cash out because you're committed to buy something. If you know you've got to do that, you can't risk that amount of volatility. So you got to stay with the cash or the CDs. Excuse me. Another question. What are your thoughts about the potential tax changes by the current administration? We really don't anticipate any changes between now and the election. It does appear that the White House has the political clout to push anything of any magnitude through Congress at this point. It does appear that the Democrats in the House have enough power to push it through the Senate, should they pass something. And remember, they passed Secure Act 2, which has pretty much died. The Build Back Better, or whatever it was called, plan, of course, fell on its face. So in all honesty, we expect some tax changes post-election prior to the end of the year. There's some cleanup and some expiration things that truly need to be addressed by Congress. But the sweeping tax changes that we heard were going to happen, we do not anticipate until post-election. Let's see. What happens after the election? You're not going to give me a break on that one, are you? What happens after the election, assuming the GOP wins the House? This gets a little tricky. I think some of the corrections that I noted that we anticipate coming are a no-brainer. I don't see any extreme tax cuts. The federal government's still spending money like, pardon the expression, more than drunk sailors. No, my apologies to sailors. So I don't see anything sweeping, in all honesty, until 2024. 2024 and 2025, we're going to see major changes because the setup when President Trump was in office and Congress passed the last major piece of legislation, so many of those laws sunset in 2025, especially in the estate planning area. By sunset, it just means they expire or they go back to the law prior to 2018. In some cases, all the way back to 2010 in the Bush era, or excuse me, 2000, the Bush era. Excuse me. So I was hopeful that there would be some changes in the tax code, but it's very uncertain. Just depends on how the seating goes in Congress. And of course, do they just do nothing or flounder or, give speeches for the next 2 years until we get to the 2024 election? Hard to believe how quickly that may get here. Thank you for any other questions at this time. I'll give that just another second. In the meantime, let's see. I want to, if you know someone who'd benefit from our webinar today, and I hope you do, we'll be offering a recording of today's presentation on the Gunn & Company YouTube channel. Once it's posted, we'll email you a link to everyone who registered, so feel free to share it with your friends and family. It's interesting. We have more views afterward than we do during the presentation. Any final questions? I don't see any questions coming in. Our next scheduled event will be our second quarter economic update. It's going to be Thursday, June the 28th at 10 a.m. Hard to believe that's about 7 weeks from now. I'm certain it's going to be interesting, especially if we have the 2 Fed rate increases we anticipate. So from the bottom of my heart, thank you for joining us. It's an honor to be here to help you and to serve you. We thank the world of our clients and our friends and people that are on today. So we look forward to meeting with you soon. Take care. Stay safe.